Well, this is Peter Sweeney.
And Mark Johnson.
We are the co-chairman of this year's RealCapital conference. The conference has now just ended, and we're having an opportunity to provide our thoughts and observations on what we think we gleaned today. Mark, do you want to start us off?
Sure. So a couple of the comments that sort of resonated with me was sort of a consistent view of the beginnings recovery of the U.S. economy. And in particular, the auto sales being one of the significant drivers of that. One interesting factoid was that the average age of a car in the U.S. was 11 years, when typically it has historically been closer to 8. I'm not sure if those cars are as dirty as mine at home, but anyway, that was an interesting fact. And certainly a view that Canadian housing market will slow down. Not surprising. I think people have been thinking about that for a while, but more so the inverse in the U.S., that the U.S. housing market will continue to pick up and has been showing strong signs of moving ahead. Lots of commentary around the REIT structure and the migration of the balance sheet construct from the typical Canadian high-paying distribution model to perhaps a more U.S. type model with less of a payout and less leverage.
I'm just curious, Mark, on that point, we heard differing views today. In fact, we heard several of the REITs who are participating in the panel discussions talk about their balance sheets not being conducive to allowing for a large unencumbered pool, and their challenge to the rating agencies to see if there were ways of changing those obstacles and those expectations.
Yeah, I think it's interesting because that may just create a divergence or polarization, as there'll be those that are perhaps in that sort of U.S. construct model, and then for others it'll be more of a migration over time. That's certainly what one of the participants was saying, that's going to be a longer term type process to sort of deleverage and perhaps then use other opportunities, whether it's the unsecured market or another form.
What about interest rates? So we heard a lot about interest rates. It was, for many, a big yawn.
Yeah. I think it was characterized at the end that interest rates were really boring to talk about and more focus on their businesses. I don't think that you can necessarily move away from a longer term upward trajectory in rates, but certainly the consistent view that I picked up is that nobody thought that these rates are going to be moving up dramatically and precipitously in the short term, as we have fragile economies, both in Canada and the U.S., that we need to have this gradual recovery before we can have any dramatic moves in rates.
I think there were two other sort of compelling thoughts that we heard today, and there seemed to be congruence on them, and that was, number one, the long rates, the longer bond rates for 10 years and longer are expected to move forward by a point to a point and a half, perhaps, over the next 2 years, and that's primarily a byproduct of what will be happening or what's expected to take place in the United States, where growth is occurring and is expected to continue to occur, which will drive and push the longer rates forward. So we did hear, in fact, that that's probably good news for many Canadian companies who are exporting to the U.S. Yeah,
and I guess the other aspect of it that we heard is there's a significant amount of debt capital available in the country, whether through the banks, life cos, pension funds, whether there's a CMBS market that might come back. We did hear that there was a little bit more scarcity of a 10-year type product. So it'll be interesting as far as if that 10-year does move up, folks are still going to have to refinance in the face of that. So it'll be interesting to see how that market dynamic plays out.
One of the other common themes that was the subject of great discussion today was whether or not the major cities in the country we're experiencing an oversupply of both office inventory and retail space. What did you hear, Mark?
Yeah, no, I thought there was lots of healthy discussion around the velocity of development that we're seeing in the city, and there was a front page article today about Sun Life's move. So I think that people are very interested in that development. There was lots of chatter about whether that's going to cannibalize other parts of people's portfolios, but the overall dynamic that I heard was that it wasn't too much, it's going to be digested, the deliveries are going to be over time, and that there should be an ability to absorb it on a reasonable time frame.
Interesting. One of the other comments we heard over the course of the day was that there is at least a belief that in Toronto, with 4 million square feet of office space, of newly constructed office space, that we may see some migration to quality from B and C buildings, and the impact that flight to quality, so to speak, may have on valuations of B and C buildings, principally outside of the city and in the suburbs. That seemed to be a common theme that was noteworthy today.
Yeah, no, that's definitely one that I picked up as well. The industrial market was also a topic of conversation today, and that was a belief that it was fairly strong, and that there is some new build that is out there, but it's typically for very interesting distribution center type aspects of that particular asset class, and that there will be strength in the industrial sector for the balance of the year. So that I thought was quite interesting.
And on the retail sector, we heard that there seems to be a growing trend, particularly among young Canadians, to use the web or the internet for much of their retail shopping, which is having a deleterious effect on particularly the B and C type shopping malls and retail locations across the country. What did you hear on that, Mark?
Yeah, no, I thought it was interesting that this whole omni-channel type delivery is interesting, but that it's not that the online shopping was going to completely cannibalize the store experience, that they are very much interrelated. People want to go into the stores, touch and feel. Some stores are being designed and some malls are being designed more as a destination location to go and have that day to go experience what you think you might want to have, and then maybe, if necessary, as one of the portfolio managers referred to it, sit on your couch and order it from your iPhone and not even go to his computer.
Anecdotally, we heard today that people are now buying dog toys and fire logs from their couches in their family rooms. Maybe, Mark, we should talk about the supply of capital, particularly equity capital, and whether or not the different panelists today thought there was a surplus of that type of capital in Canada in 2014.
For equity.
For equity, yeah.
Yeah, well, look, I think that we've got a bit of a market digestion to get through from a public REIT and REOC perspective. I think that we've seen the beginnings of that rebound come back. We're certainly up off the lows from the precipitous decline after the May-June announcements from Fed tapering. So I think it's just going to be a clawing back. I think the people will need to prove that they can operate in this environment, and it'll be less of an acquisition story, and it's going to be more about just the block and tackling every day, running your office buildings and running your retail businesses or whatever they may be.
And we also had many discussions about the availability of product for both pension funds, REITs, REOCs, and private investors. What did you glean from those discussions, Mark?
Well, what I gleaned from that is that the investment market seems as though it will slow, and that certainly the pension funds have taken the view that in order for them to find the assets to fill their portfolio and their unending capital requirements that they have to put to work, and larger real estate allocations in the pension funds, they've taken the decision that development is where they're going to go. They're going to get new product that'll last them for the next 40 years, and they'll sell out some of the stuff that they have had for 40 years. But it will take time, and they're also sitting on land banks that might not be developed for 20 or 30 years. So they're taking an extremely long-term view, and that I think it played out in sort of the pension fund and their view of development. I think that from the public real estate company perspective, that the development aspect of their business is where they can add value, they can grow cash flow. They have to do it in a much more measured fashion, and certainly we heard that from not only some of the operators of the REITs, but we heard it also from the portfolio managers. There's a limit of development risk they want to see in those entities.
And one of the challenges I think we heard was the cost of capital. So whereas the pension funds seem to continue to enjoy a very low cost of capital, the cost of capital for most REITs and private entities across the country is not where it was a year or 2 years ago. We heard that from many of the panelists today as well.
Yeah, that's right. Yeah.
Maybe lastly, we can wrap it up with respect to final thoughts and final words, Mark. So any final thoughts or words on your side?
Yeah, just I think what we heard is that this is just going to be a grinded out kind of year. It's not going to be particularly dramatic from a transaction perspective. We obviously things change and things can come out of nowhere, but I think it's going to be just a slower growth year.
I'm going to characterize my final thought by paraphrasing what we heard from Blake Hutchison, who was very bullish on the 2014 calendar year for his company, where he thought that it would be very much like the prior years, where many of the metrics that determine whether or not a real estate company in Canada can be and should be successful should continue through the year. So continued low interest rates, continued high employment, continued improving economies south of the border, therefore improving exports, and a continued consumption of office, retail, and industrial space in the major markets across the country. So that seemed to be one of the common themes that not only Blake but others like him were propagating over the course of the day. So it's very much a repeat of perhaps last year's common stories.
Yep, no, exactly. That's
Thank
great.
you, Mark.
Thank you, Peter.
Great conference. Thank you
Okay,
very much.
take care.